Taxes. Picture this. Imagine you just had a hard month at work, slaving away flipping burgers at your local McDonald's. You're in bed when you get an email from them. It says you've been paid $2,000, but your bank account only gets $1,456. You scroll down the stub: federal income tax, state tax, Social Security, Medicare. This is the modern ritual of giving away a chunk of your money to invisible forces, and they expect you to say thank you. Here's the deal. Taxes are the cost of civilization. You pay, the government builds roads, funds schools, makes sure your favorite taco truck isn't infested with rats, and sends billion-dollar missiles. But there are different types of taxes. Income tax, which hits the money you make; sales tax, which hits the money you spend; capital gains tax, which hits the money your investments made while you were asleep. The government takes a little bit of every dollar. Nearly everyone also pays Social Security tax and Medicare tax. Basically, Social Security tax is like the government forcing you to save for your retirement. They force you to save money now, and you get it paid back to you over time when you retire. Medicare, however, is a health insurance tax that goes to supporting older people or people with serious health issues. Now comes filing your taxes. Oh boy. The government knows how much you owe, but it makes you guess. How cool. If you're right, no worries. But if you're wrong, you're cooked. When it comes to actually paying taxes, some people pay every few months, some people pay yearly. And then there's those people that don't pay at all and end up in documentaries. I get the taxes are annoying, but it's not all bad. Countries with higher tax rates generally have a higher quality of life all around. Banks. So, you walk into a bank, you hand the cashier your money, they count it, smile, and tell you it will be added to your account. You walk out and think, great, now it's sitting in a vault somewhere, being guarded by a dragon. But in reality, that money's already gone. Most people think of banks like a big safe with only one job: guarding people's money. But in reality, they're just a middleman or a matchmaker for financial transactions. When you deposited that $1,000, the bank took $900 of it and gave it to someone who wants to buy a jet ski. That system is called fractional reserve banking. It basically relies on the idea that they only need to actually keep a fraction of the money on hand, because not everyone is going to show up at the same time asking to withdraw 100% of their account. That is, unless it's 2008, of course, when people lined up to withdraw the entirety of their account, which caused the entire system to crumble. Banks make money by lending your money at a higher interest rate than they are giving you. That's really it. You're the supply of money, and the person borrowing is the demand. The banks entice you to deposit your money because of a few reasons. It's much easier and more convenient to spend on a card or transfer than carrying around cash all the time. They're literally paying you to hold your money with them in the form of interest. It is much safer to keep your money in a bank than in a shoebox in your room. In the U.S., most banks are insured up to $250,000 per person, meaning no matter what, the government assures you that your money, up to $250,000, is safe. Interest. Imagine you borrow $1,000. You have to pay back $1,280. Why? Because of interest. Interest is money's way of charging rent to exist in someone else's hands. When you borrow, interest is the price tag for using someone else's cash. When you lend or save, interest is the reward for being patient and boring. There are two main types. Simple interest. Here's a flat fee, thanks for playing. Compound interest. Every dollar I gave you now has clones, and they also want rent. Let's say you owe 20% interest on a credit card. You miss a payment, now your interest is earning interest. Soon, your $12 burrito turns into a $50 regret. On the flip side, investing at 7% annually is a great way to save money. You can also borrow money from a bank. That's your money duplicating itself like a cheat code. Then one day you wake up and you're old, rich, and a little smug about it. This is why interest is the silent engine behind both wealth and debt. In loans, it's the slow burn that turns small mistakes into financial fires. In investments, it's the time bomb that turns small gains into massive wins. So, what's the hack? If you're paying interest, kill it fast. If you're earning interest, let it sit, feed it, and give it time. Interest is either your worst enemy or your best unpaid employee. The choice is in who's collecting it. Inflation. Okay, so you bought a bag of chips. You open it, and it looks like it's already been half-eaten. You check what you paid, 30% higher than last time. Then you realize you've just been hit by inflation. Inflation is what happens when money slowly gets less valuable over time. Not overnight, not with fireworks, just a slow erosion. Your $5 bill is still technically $5, but it buys less instant noodles, less gas, and doesn't actually have as much value as it did before. So what actually causes it? Sometimes people just have too much money. Everyone's got cash and they all want to spend it on the same stuff. Let's say 2,000 people want this $500 TV, but the business only has 1,000 TVs. So the business goes, oh, everyone wants this TV? That'll be $800 now. Sometimes it's supply chains with hiccups or problems, making the cost of producing a good or service more expensive, meaning the price must rise. Or sometimes just expectations. If people think prices are rising, they'll spend more now, driving prices up faster. It's a self-fulfilling economic prophecy. A little inflation is normal, even good. 2% a year is fine and predictable, but if it spikes, savings die and wages lag. The government tries to fight inflation by raising interest rates. When interest rates go up, loans become more expensive. People have less money to spend. Spending drops. The economy cools off. Recessions. A recession is when the economy decreases for at least 2 quarters, 6 months. One day you're fine, you've got a job, bills are paid, you might even be planning a trip. Then suddenly, layoffs. The stock market is only going down, companies cut costs, people stop buying things they don't need. Why does a recession happen? High interest rates, a global crisis, war, pandemic, rogue container ship, or just the economic cycle doing what it does best. Boom, peak, bust, reset. Think of the economy as a party. In the boom phase, everyone's dancing and drinks are flowing. But eventually, the lights flip on, someone checks their bank account, and the DJ is suddenly playing sad lo-fi beats about corporate downsizing. Recessions aren't forever. They're resets, painful ones. Governments might lower interest rates, send out stimulus, or just hope people start buying overpriced coffee again. Eventually, spending returns, businesses rebuild, growth resumes. But not without scars. Credit scores. A credit score is a shadowy algorithm that knows your name, your past, and how many times you paid your credit card late. A 3-digit number that decides whether you get a house, a car, or a soul-crushing 27% interest rate on your new TV. This number isn't about wealth, it's about trust. Lenders want to know, if I give this person money, will they actually pay me back? The score ranges from 300 to 850. Below 580, you're a walking red flag. Over 750, sparkling with adult credibility. Most people sit between 640 and 790. How is it calculated? Payment history. Do you pay on time? This is the big one. Credit utilization. How much you're using versus how much you could. Credit age. How long you've had accounts. Credit mix. Cards, loans, mortgages, variety helps. New credit. Too many recent applications hurts. To increase your score, you have to make the required payments on time. Miss the late period, your score drops. Your credit score is like a pet dog. Ignore it and it ruins your life. Take care of it and someday it might help you buy a new one.